Hello, this is Ben from the Institute of Trading and Portfolio Management. I hope you're all doing well. I have two ideas I want to discuss today. But first, let's have a look at the macro data. So the most recent readings for the ISM Purchasing Managers Index, or PMI, was mixed for September. Okay, so the manufacturing side continues to be flat, hasn't really changed much over the past few months. But the non-manufacturing, also known as the services portion, was actually very strong. It was the strongest since February of this year. And it was led by a pickup in business activity and new orders, which is something to note. Okay, then a few days later, we had the US non-farm payroll data. This came out screaming higher, the economy adding the most jobs in 6 months, and is boosting way past estimates. Then we had the Consumer Price Index posting a 2.4% year-over-year change for September. And while that was a tad above the forecast of 2.3, inflation has stabilized. Okay, and the economy is hanging in there, actually. It's doing quite well. So what are we looking at here? We have a moderately growing economy combined with what is likely the beginning of an interest rate easing cycle following the 11 rate hikes that we had. Plus, the last quarter of the year is usually quite strong. So we really have all the ingredients for a solid run into year end. The question now is, how do you position yourself on the long side without being overly correlated to kind of high growth stocks that most funds out there are? If you just look at the top 10 holdings for the S&P 500, they make up 35% of the index. And besides Berkshire Hathaway, they are all tech names. Okay, and 57% of the S&P consists of technology, financial services, and healthcare. And industrial companies only account for less than 8%. So this is a situation where kind of the old school classic manufacturing and infrastructure companies have taken a back seat. And having exposure to this space will clearly keep you better diversified. And there are a lot of names within that segment. I found one that I really like. I'm going to zoom in on that. And it's MasTec. Okay, MTZ is a $10 billion market cap company with infrastructure and construction as their primary business. And even though it's a small to mid cap company, they've been around for 80 years, okay, and they employ over 20,000 workers. So they have a lot of experience handling all kinds of challenges and market conditions. And under the hood, they're firing on all cylinders. We're looking at 40 to 50% forward-looking earnings growth. And speaking of earnings, by the way, they're out on November 1st. Expectations are for $1.23. However, with that potential windfall from the economic, kind of global economic rebound, like in China as well, I think it can blow right through these estimates. And the balance sheet is healthy, $3.5 billion in total current assets versus $2.7 billion in current liabilities. So no worries there. Looking at a PM multiple of around 30 for the next few years. So there's room for expansion. So here's a chart of the stock, it's a weekly chart, and you can clearly see kind of this triple top being broken to the upside, which typically leads to higher prices when backed by solid fundamentals fitting into the current macro scenario. Not that we rely on price action for our trades, okay, but when used correctly, it's just another tool in the overall process. So anyway, this stock is up close to 30% since it's made a short-term bottom in September. And I think you could easily repeat that over the next few months and then some, potentially reaching kind of 160 to 170 area later this year. So let's have a look at the chain. Now, we can buy 8 of the December 130 strike calls, mid-spread, at $750 each. Total spend is $6,000. That means that it is out of the money with a strike higher than the last price, and you're purely just paying for time value at this point. And then, like we often do, you can hedge out some of that premium spend, okay, by also selling the November expiration 140 strike calls at around $250 for a $1,000 credit. Now, the goal here is for the stock to stay at or below 140 by November 15th, in which case they will expire worthless, letting us keep all the credit received. Now, we often do this in the same size, but you can also do it as a ratio where you sell less than what you buy. It kind of depends on the situation at hand. Okay, so it's a case-by-case type of situation. Now, in this case, because they have earnings before the short strike expires, okay, it makes more sense to do this as a ratio, where you only sell half. So selling 4 contracts versus the 8 that you bought. And why do we do this? Well, it's because when they're earnings, stocks typically can have pretty aggressive moves following earnings. So let's say earnings come out hot and the stock just blows right through 140. Well, in that case, you'll still do quite well, actually, but you're going to sabotage your profit potential because now you're short the same amount of contracts that you long. So don't worry about all this math, by the way, and I'm going to throw some more at you here. I'm going to teach you everything you need to know during our 12-week mentoring program. So what's the bottom line here for MTZ? Long 8th December, 130 strike calls at 750, $6,000 cost. Short 4 November 140 strike calls at 250, $1,000 credit. Total cost $5,000. Let's say the stock is right around 140 at the November expiration. In that case, they will expire worthless. We keep the $1,000 credit and move on. Now, at that point, we just end up long. Okay, and then we just have long the 8 December 130s. And then the stock rallies to, let's say, 170 by December. In that case, the math for the long calls works out to 170 price, okay, minus the 130 strike, minus the 750 cost, times the 8, that's the size, times the 100 multiplier. And that comes out to a profit of $26,000. And the short leg also has a $1,000 credit. Okay, so the total profit then is $27,000, which is more than a 5-to-1, my friends. Reward risk. Pretty juicy. And that's if you don't add another short leg, which quite often do. It's an option that we look at during our gatekeeping process. It's a classic old school setup with realistic expectations, and it's a pretty typical scenario for our mentees. Okay, so that's just one stock. Now, you can also look at an ETF play here that fits into the narrative. And yeah, we can go with a basic kind of industrial or construction names. But if you want some serious returns, like with stocks, you have to think a bit outside the box here. And one that I found that I really like is PAVE, PAVE. Okay, it's a global infrastructure and development ETF. It's just a perfect match for what we're trying to achieve. So it has just broken out of this kind of 6-month range following a pretty serious rally that started end of 2023. And there's this massive upside potential here. So if you look at the top 20 holdings within this ETF, you'll see that these companies just fit perfectly into the global infrastructure old school expansion that's going on. However, though, there's one challenge there. Okay, there's a lack of options liquidity, which I'll get into in a bit. And if you look at this chain, you can kind of see it where the volume and open interest is just not quite there. More importantly, the bid-ask spread is wide. Now, there are other reasons, but this is one reason why this is purely a long call play, initially at least. And you can add a short later in the game. So the December 42 strike calls are currently bid at $1, offered at $1.25. Meaning we can buy them at $1.25. Okay. However, the bid-ask spread is pretty wide, and you always want to try to, well, not always, but in this case, you want to try to get filled mid-spread. Okay, because if you just buy the offer, sell the bid, execution costs can really put you on the back foot. So we talk a lot about execution during our mentoring programs, and it can really make or break a great trade idea. You can have the best trade idea in the world, but the execution isn't right, it's just not going to play out. So all right, so the setup here then is to place a good to cancel order, GTC, middle of the spread. So 50 contracts at 120, which is actually leaning more towards the offer side anyway. But with the understanding that that's going to take some time to get filled, most likely. And it will cost $6,000. And you could just leave it at that, and that would be great. However, what if after that position is filled, we then place a sell order to short the December 50 strike calls at 50 cents? Again, GTC, you put it out there, it just sits there. And yeah, it's miles away from that now. But look, if the underlying rally is to around 48, someone might lift that offer and you get filled at 50 cents. And in that case, we have a pretty amazing setup where we're long 50 December 42 strike calls at 120, $6,000 cost, short 50 December 50 strike calls at 50 cents, $2,500 credit, total cost $3,500, and it's now a vertical spread. So check this out. Stock gets to 50, okay, by the December expiration. Longs, we have 50 minus the 42 strike, minus the 120 cost, times the 50 contracts, times the 100 multiplier, profit, $34,000. Plus $2,500 credit on the short side. So you have a total profit here of $36,500. Okay, on a $3,500 spend. So it's a 10 to 1. Okay, so that's just insane. And of course, these scenarios don't always play out the way we plan, right? But it's a beautiful thing when they do. And they do more often than not, by the way. So these are just two examples that fits into the current macro developments. And we teach you how to uncover and structure all of these ideas within our programs. That's it for this episode. Catch you later. Over and out.